Welcome back. We are live from the CITIC CLSA India Forum, and joining me today is Aditya Soman, who is the India research analyst, senior research analyst tracking the consumption and the internet sector. Aditya, thank you very much for joining us on ET Now. To begin with, consumption is a talk of the town. We saw the GST cut happening towards the end of September. We saw many of the companies, talking about deferring of sales because of this entire uncertainty of GST. How do you see the entire Q2 with respect to consumption?
No, absolutely. Great questions, and thanks for having me, Sujit, on the show. Two things. So firstly, with the GST cut sort of happening towards the end of 2Q, there was a disruption in sales. I think most companies went through a period where they needed to sort of take care of stocks, inventories with the dealers, and then get them back out. I feel there's disruptions now behind us, and you should see a fillip to consumption, particularly as we sort of saw a relatively healthy consumption period during the festive season in October this year. That being said, structurally, our view remains that for FMCG in particular, the competitive intensity continues to rise, particularly as distribution and platforms, whether it's quick commerce, modern retail, is rising very rapidly. This means that the ability of smaller players to compete for that market share has gone up very significantly compared with back in 2018-19 when you had a sort of GST cut back then. At that point, the larger companies actually saw most of the benefit come through for them in terms of market share gains as we move towards a more organized world. But this time round, our view is that yes, in the here and now, consumption will pick up, but I'm not sure the biggest beneficiaries are the largest companies.
So you're saying that the consumption may shift to some of the unlisted peers, or for that matter, the regional players in that sense, is it?
Right. So one of the things we've highlighted in our we've recently written a sort of 480-page report on consumption.
480 pages.
Yes. And one of the things we talk about in that is how the opportunity is really focused on the premium end. That being said, obviously India is 300 million plus households, still very low consumption per capita. So the overall consumer opportunity remains large. Historically, if you were a large company with a deep distribution, particularly in rural, sort of small town India, it was very hard to compete. Secondly, in terms of kirana shops, which were the dominant sort of retail format, it was very hard for sort of a smaller player to break through. Typically, there was a constraint, and most kiranas would keep it to maybe 2 or 3 products per category. But now, once you sort of shop on quick commerce or e-commerce, the aisle is effectively endless, and the ability of smaller players to sort of access consumers has gone up. Secondly, if you think of sort of advertising, that's been a big moat for some of the large consumer companies. It was very difficult to break through for a small company in advertising. Obviously, the upfront cost of a television or print ad was fairly significant. Now that's changed, right? Because you can sort of, again, use performance marketing, use social media to gain sort of a brand recognition at a smaller scale and then scale up. And this is one of the reasons we feel that the competition we are seeing is very structural and likely to increase as distribution becomes more ubiquitous for quick commerce.
Interesting that you said that. Are you saying that a lot of volume share is now being taken away by the mid-tier companies per se, and do these mid-tier companies have ability to scale it up?
No, absolutely. Great question. And I think we've seen, so I would answer this in 3 ways, right? So one, it's very clear that smaller and mid-sized companies are gaining market share. Even if you track sort of panel data, let's say from Nielsen, it's very clear even on that smaller companies have outgrown the larger companies. So those with a turnover of over 5,000 crores have actually grown the slowest in the past few quarters. In my view, Nielsen doesn't even capture the full story because often they miss out on data from sort of quick commerce and because it's a retail survey. If you were actually to aggregate data from quick commerce, then the share losses are probably even larger. That being said, I think the point you bring up is also very valid, that scaling up a business to 200-300 crores is not very difficult. I would say a lot easier than it was before. Going beyond that, becoming a national brand is still not straightforward. We've seen only a few companies really break shake out into sort of the thousands of crores, and it's actually not as straightforward. That being said, I see sort of a lot of smaller regional competitors emerge and stay competitive. And if I was a small businessman, let's say outside of the metros, I would actually be fairly happy with a 200 or 300 crore revenue. So
it also begs to ask the question that that brings in the entire consolidation mode in the industry, because if many of the businesses are not able to scale beyond the 300 crores and become national brands, then they are subject to getting acquired by some of the larger brands. We saw that a wave of that happening maybe a couple of years back, immediately after COVID, when we saw FMCG companies acquiring smaller brands who were active digitally in that sense. Are you going to see a similar thing here as well?
Absolutely, and I think one of the reasons why Indian consumer companies in the past had very high ROEs or returns was because the businesses were built organically. They didn't have to invest as much in acquiring businesses compared with, say, global FMCG companies, which have always been very acquisitive. Now we see a trend in India as well, where if you cannot grow organically, you're often forced to acquire some of these newer companies, especially if they are in accessing the market through differentiated ways, right? Whether it's sort of digital or whether it's sort of D2C brands which are getting acquired, or if they sort of play in a niche category. So we've seen actually a spate of acquisitions even recently over the last few quarters, and I feel that is something that will continue to go up. Now, the side effect of that is one, obviously the smaller brand gets subsumed in the larger company, and which then gives it access to certain attributes. But then the other effect is obviously you see ROEs come under a little bit more pressure. So we've seen ROEs at some of the largest consumer companies, which used to make sort of over 100% returns, now come down to sort of more moderate levels. Is that a bad strategy? I don't think so. I think 100% ROE doesn't solve anybody's issues. I think obviously what investors are willing to pay the multiple is for growth, and I feel the balance between growth and ROE is something that you should look for.
We've also seen a clamp down on the EV by EBITDA multiples for many of the FMCG companies. Do you think that now we are coming to a stage where the band of that multiple, which used to be 60, 70 times, is now going to come down to 20 to 40 times?
Yeah. Well, I mean, obviously different companies have different
ways, but I'm just trying to say that is there a drastic shift in that way in FMCG companies multiples are going to be looked at?
Yeah, no, great question. So in my view, there were three reasons why that multiple was high. One, there was a scarcity premium. So you had only a few companies to play really at a national level if you wanted to play India consumption. Then if you sort of cut it by governance and things like that list actually whittled down to fairly small number. That is changing, right? So now we have a lot of these newer companies coming in, getting into the indices as well, whether it's sort of the small mid-cap indices, or even sort of the larger, broader indices. We've got companies like Eternal or DMart now in the Nifty. I think that changes, right? So now from an investor perspective, you have more choice, more companies, and that scarcity premium to some of the consumer multiples, I think over time will erode. That being said, I still feel that the consumption opportunity in India is incredibly large. We're just scratching the surface in terms of the opportunity. One of the things we highlight in our report is while the urban affluent and middle class cohort is not very large, from a percentage of population perspective, if you look at the absolute numbers, we're talking about sort of 50 million households going to 85 million households, and with the potential consumption power of Germany in 10 years. So the absolute consumption, even of these larger affluent cohorts, is actually very large, and hence the opportunity is fairly sort of long-term in terms of a multi-decadal opportunity for these consumer companies.
You spoke about the companies there. Now let's look at the distribution model, which is retailers. They also were trading at a very high multiple. Now we have platforms coming into play as well. So the multiples are getting corrected because the platforms are taking away their share, which is not getting covered or captured in some way, but that's happening on the ground as well. So how do you look at some of the retailers like a Trent or others who are doing it, but at the same time you have the tier 2, tier 3 retailers who are doing absolutely well. Then earnings have been very good in this quarter for many of them compared to pan-India retailers. So how do you look at that?
No, great question. I think structurally, I feel that we are seeing a big evolution in retail in India, whether it's sort of modern retail, which addresses sort of value, whether it's players like sort of D-Mart, Vishal Mega Mart, really doing very well on value. On the other hand, you've got the convenience channel being addressed by quick commerce, or then you have sort of niche retailers like Nykaa, which are sort of targeting specific categories. I really feel that it's solving for three needs. One, it solves for consumers' need for choice. Consumers are demanding more choice. As I said before, kironas just cannot meet that requirement. So that's a natural shift we're seeing. Second, I think obviously consumers are demanding convenience in place, especially in large cities in India where traffic is a constraint, parking is a constraint, and often even vehicle sort of ownership is still relatively limited, unlike say the US where people can drive around in a pickup truck and pick up groceries for the month. I think that habit is very different in India, and hence a channel like quick commerce solves for these differences. And then lastly, it's also about affordability, right? Because you're eliminating a lot of the sort of chain, which was, I would say, in some cases inefficient. It brings down the effective consumer price once you shift to a more modern channel. So all these three factors, I feel, are big drivers of this shift towards platform or to retailers. I still feel both will coexist. One sort of solving for value, the other solving for convenience, if you look at sort of a big picture.